One narrow shipping lane carries roughly 1/5 of the world's oil. If it slows down, oil prices can spike. Inflation can wake up. Markets can panic. Not because of Wall Street, not because of a central bank. Because of a strip of water between Iran and Oman, the Strait of Hormuz, the oil market's kill switch. The Strait of Hormuz sits between Iran and Oman. It connects the Persian Gulf to the open ocean, and through it moves one of the most important energy flows on Earth. In 2024, about 20 million barrels of oil per day moved through the strait, roughly 20% of global petroleum liquids consumption. That is why markets do not just watch this waterway, they fear it. A kill switch works because it controls a system from one pressure point. Hormuz is that pressure point for oil. The International Energy Agency says around 20 million barrels per day transit the strait, equal to about 25% of world seaborne oil trade. So if ships slow down, insurance costs rise. If insurance rises, shipping gets expensive. If shipping gets expensive, oil gets expensive. And when oil gets expensive, inflation wakes up. Most people think oil prices move because of supply and demand. That is only the surface. Oil also moves on fear. Fear of disruption, fear of war, fear that a tanker cannot pass, fear that one spark in one narrow waterway could spread into gasoline prices, food prices, and airline costs. This is the real power of a choke point. You do not need to control the whole market. You only need leverage over the place the market cannot easily avoid. The IEA says only about 3.5 to 5.5 million barrels per day of pipeline capacity could redirect crude flows away. But that is far less than the oil normally moving through it. The system has backup routes, just not enough of them. That is why the market reacts before the worst-case scenario even happens. Traders price risk early. Shipping companies reroute early. Insurers raise premiums early. Governments issue warnings early. And investors sell first, ask questions later, because oil is not just a commodity. Oil is an input into almost everything. Here is the chain. Oil rises, fuel rises, shipping rises, food and goods become more expensive to move, inflation pressure returns, central banks hesitate to cut rates, stocks lose the easy money story. And suddenly, a waterway near the Persian Gulf is affecting portfolios around the world. And the pressure does not hit every region equally. The IEA says about 80% of crude oil is destined for Asia. That means China, India, Japan, South Korea, and other major economies watch this strait closely, because energy security is economic security, and economic security is power. The lesson is not that one country controls the global economy. That would be too simple. The lesson is darker. The global economy built speed, efficiency, and cheap energy around fragile choke points. And when a system depends on narrow passages, the passage becomes power. So when headlines mention tension near the Strait of Hormuz, the market is not only reacting to politics. It is reacting to dependency, to oil dependency, shipping dependency, dollar dependency, inflation dependency. The fear is not just that oil stops moving. The fear is that everyone remembers how fragile the system really is. The oil market's kill switch is not a button. It is a bottleneck, a narrow corridor where energy, war, shipping, inflation, and financial power collide. One narrow strait can reprice the world. And Hormuz is proof that money does not just move through banks. Sometimes it moves through water. Thank you for watching.